people get caught up on is well, I have a 4% interest rate. I love my interest rate. It's 4%. But reality is it's debt. Like it is money that you have borrowed and you have to pay back. So hey, this is Scotty from the Gifford Group, and today I just wanted to walk you through our new tool. It's the loan comparison tool, which would be great if you have a current mortgage and you're thinking about refinancing, or if you're thinking about doing a buyout. If that's what we specialize here at the Gifford Group, is helping people make informed decisions about the home through when they're going through a divorce process. So we built this tool because we've been we helped a lot of clients and we kind of helped them. In most cases, one of the spouses, it makes sense to keep the house. Sometimes it's too big for both of them, or they just can't afford either of them and they need to sell, and we can definitely help you do that if you want. But we get this question a lot, is can I afford to keep the house? And so in the last turn we get every day is, hey, I have a 3.5, I have a 4% interest rate. Is there any way I can keep that rate? And the short answer is no. You can't keep the rate that you had back then if you're going to be getting a new mortgage, right? You're refinancing, you're paying off the old mortgage. There's going to be some refinance costs associated with that. But the good news is, hit the Gifford Group, we do have some secret tools that allow you to roll in some of the other debts, which then helps your DTI ratios, which then allows you to keep the home, because from a cash flow standpoint, it makes sense to keep the home. So it might be a little bit more expensive, or it actually might save you money on a month-to-month basis on a pure cash flow standpoint. Obviously, you're rolling in the debt. It's not getting paid off, but you're paying it off a 30-year mortgage, which is, you're amortizing over 30 years, so the payment is lower. In a hypothetical situation, we'd say, hey, we had a client that had a car payment of $600 a month. It was like $30,000. On that same scenario, the calculation went down to over the $30,000 on the 30-year mortgage went down to like a $250 a month payment. So saving them about $350 a month. So from a cash flow perspective, although the debt was still there, they're amortizing over a longer time, which is a powerful tool, which is how most Americans build wealth, is staying in the home, allowing the home to keep appreciating. They have a place to live now, and then if they can afford it now from a cash flow standpoint, because their debt to income ratios still make sense, well, then we've helped them accomplish what they want to do, which is one of them stay in the home. So our goal is not to push you one way or another. Our goal is truly to help you make informed decisions about what you can do with the home, what you can do, and if it makes sense to do that. And if not, if it doesn't make sense, if you can't afford to do it, well, then we can help you sell the home as well. But let's go check out the giffordgroup.net right now. All right, there's two ways to get to this calculator currently. One of them is going to be if you go to the calculators page, and then you can do the loan comparison tool and drop down. And also I have it currently under the current mortgage rates, because usually if you're looking to see a thing about refinancing, you want to know what their current rates are. Now, these rates right here aren't for everyone. This is just the rates that, on average, the average person's getting. Obviously, points are being considered in here. They're buying down the rate. And this is the loans that they're locking in. And these are usually about a week old data. But it can at least give you an idea of where we're trending. You can see, the national rates we hit, 30-year mortgage, we're close to 8, if not around 8. And then I've dropped back down recently as recording this video, so which is a good thing. All right, I try to make this tool as simple as possible, and I'll try to walk you through it quickly as possible, just to give you an idea. And you can always go to the giffordgroup.net, which I'll link to below. You can check it out yourself. So first thing is asking, are you going to be rolling other debts? If you're not, you can just look at the, hey, here's the mortgage, and then you can scroll down and put in what your new mortgage, if you need to borrow any money, what your new mortgage would be. But most people, it makes sense that if we're going to be doing a cash out refi or a buyout, we're looking at to roll in some of those debts. And so in this example, you can put in whatever you want. Let's say someone got $325,000 mortgage and a 30-year mortgage, and then it's 4%. It's going to tell you, okay, here's your payment, $1,551, and then right now we have other monthly debts right here, which then totals up to the total of $1,800 a month. So this is based off of this inputs here. So any balance based on if you look at your statement and what your minimum payment is, or what you normally pay for that payment, you can put that in there. But this is just to help you get an idea of how much cash each month you are spending on your debt repayments. So you can put in, let's leave that one there, and then we can put in another one. We'll say, hey, this is we have another payment of $4,000 on our credit card, and that one's saying maybe it's high interest rate, maybe we're paying $275 on that one. So it's going to add up the total monthly debts, and as you add, debts, it's going to allow you to, and say we got a $10,000 one there, and that one's $500 a month. So okay, quickly you can see the other debt payments here. Okay, so now we're at $25.76 total outflow cash between the mortgage. Now we're not talking about, we're not including tax payments or insurance payments or HOA payments in this. This is just purely from a debt perspective we're looking at, because those things you'll have those the same no matter what. This is just trying to get down to nitty gritty of what we're looking at for the house wise. Obviously, those things need to be taken into account when you're actually looking at getting a mortgage. But from the now standpoint, like this is the main focus we need to focus on, just to see if it makes sense from a cash flow perspective. All right, so what this did was it took your mortgage here, $325,000, and it rolled in a refinance cost, which I can choose not to include if I want. And I have this set up as like right now is like $11,000 for refinance costs. It might be high, it might be low, but it's just, hey, there's some costs associated with doing the refinance. So right now it says, okay, that's all the mortgages plus refinance plus the debts up above, and even at 7%, that new total payment on a 30-year mortgage would be $23.65. And so we actually saved $211 a month, because if we, our total debts was 25, and now we're at 23. So it just gives you a good idea of like, hey, does this make sense for me to roll in these debts from a cash flow perspective, right? So I hope that's useful for you. You can put your email in here; it'll send you the results. And also included this, can I afford this? And you can try to change your debt ratios over here. The Fed would say, hey, we recommend 28, but if you're looking to do refinance, you're probably going to be, by yourself, or, we get usually 40% is not a problem. 42 is kind of, we're pushing it. 45 is like, oh, okay, we got to get everything else paid for to be able to do this. So, but you can adjust that if you want. It kind of tells you how much you need to make either hourly, monthly, or yearly, based on your, your gross income. Because in mortgage world, we look at your gross income, not your net, not your take-home pay, but actually how much you make yearly, before taxes and all that stuff like that. So that's good. So you can put your address in there, and if you're ready to get a pre-approved for mortgage, you can fill this out, and then one of us will contact you. You can also click the link up here, which will take you directly to our website, where you can then start the application yourself. This is just another way to do it. So hopefully this is just a quick overview, if this makes sense for you or not. And I'll dive one level deeper for the people that, if you are looking to buy out your spouse and maybe you need to give them some of the equity, kind of specialize in is helping one spouse buy out the other spouse, buying out their interest in the property, right? One of them's going to keep the home, one of them wants off the mortgage, and one's off the deed. And so the other one wants to keep the house. So how much more extra money do you need to do that? And we have tools. We have the buyout calculator that can help give you an idea of that. Obviously, we can help you provide a CMA or a comparative market analysis, which will help establish the value of the home. And then if we get to the point where you actually need to actually buy out your spouse, we can actually provide you, we'll order an appraisal through the bank, which then that'll be the real amount we can borrow off of, and the actual amount of equity we can give to the out spouse, and assuming you can afford the mortgage, correct? Like in the scenario, let's say that we need to give the out spouse, $25,000 too. So we're going to include that into the new mortgage, because we're going to give them the $25,000 on top of paying off these other debts, so that when she walks away and you walk away, we don't have these credit card debts that are in both of our names, or maybe it's a car or whatever those debts are. And so we can see, even given her $25,000 in this scenario, we still saving $45 a month. People get caught up on is well, I have a 4% interest rate. I love my interest rate. It's 4%. But reality is it's debt. Like, it is money that you have borrowed and you have to pay back. So all you're talking about is that you got a great debt payment. Like, good for you. At the end of the day, what most people really truly care about is how much it costs you each month to live in that property and to pay off your debts, right? It's 90% of Americans have this problem and need to worry about cash flow, how much are coming in. So in this scenario, you have a new mortgage of say $380,000, right? More than your 320 you had. So you're borrowing more money, and you're borrowing at a higher interest rate. But because we were able to pay off some other of these debts, and because we need to give money to your soon-to-be ex, that allows you to stay in the home still. And if you can afford it, if you make, in this scenario, say you make $85,000, it looks like you can afford to stay in the home, then you can keep the home, which is then, and we can have, that's going to be a whole other discussion about whether you should actually keep the home or not. And I have a lot of honest conversations with clients about this on a weekly basis about if that's their best thing. I don't make the decision for them. I just ask them questions and help them walk through the scenario if that makes sense for them. So we really come from a place of trying to help. Me and my wife, Amber, are just, she's phenomenal at helping people walk through these scenarios. And two, you need to think about can you afford the house? You're questioning, what about the other debts? We have a whole team of people we connect with to help with CDFAs. We have attorneys that we work with on, that we refer out to. We don't get money from them or anything like that, but we partner with these people because we trust these people. We work with them. We refer other clients to them. We've gotten great feedback from those attorneys, and so we're always growing our network of people. We have therapists that are we have coaches out there. So whatever you need, we try to be the connecting piece to help you get connected to whatever it is. And hopefully this is one of those other tools that you can either use yourself or that we'll end up using to help you help determine whether or not you keep the house. This is before you start getting too deep into it. Once you are ready to apply, we can definitely move a lot faster and get you answers to that, and then work with your attorney as well to help them. Hey, yes, Joe can keep the house and he's pre-approved to keep the house, or it looks pretty bad for them. They probably need to be selling the property or not, and you can at least prepare yourself and know reality standpoint whether or not you keep this house, and not trying to just fight and claw to keep something that you really can't afford to do. So we're not here to tell you right or wrong to want to keep the house or not, but we're just really trying to help you understand whether it makes sense for you or not. So hopefully this tool helps out. If you have any questions, you can put them in the comments below. I try to always respond to the questions. Hopefully you found this video helpful. So like and subscribe if you're looking for more content like this. We've been doing a lot of shorts lately, which I think has been a really great content. Hopefully, this part of this video will be something useful for you too. And, tell your friends and family if you have someone going through divorce that we're here to help. And you can always schedule a call with us on the Giffordgroup.net. Go to contact us, a 45-minute consultation call. So I hope you found it useful.